Technical analysis is not just about patterns, indicators, or drawing lines on a chart. The real difference between losing traders and consistently profitable traders is mindset, execution, and understanding how the market actually manipulates emotion. In this video, you'll discover why so many traders fail even after learning strategies, and what professional traders truly focus on behind the charts. Featuring powerful insights from Alexander Elder, Tom Hougaard, David Paul, and Francis Hunt, this video breaks down the psychological traps destroying retail traders and the 7 mindset shifts that can completely change the way you trade, manage risk, and approach the market. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Let's begin where it all started, with Alexander Elder explaining the true origin of technical analysis and why trusting patterns too much can lead you straight into trouble.
Classical chart analysis. Classical charting began, that's how technical analysis began. It began a long time ago with a man named Charles Dow, who was editor and owner of a little broadsheet that went out called the Wall Street Journal. And he came up with this concept: averages discount everything, meaning everything is reflected in prices. He never wrote a book, but he wrote many editorials. And after he died, the magazine was bought by the family who eventually sold it to Rupert Murdoch a few years ago, a family from Boston that owned it for decades. And they hired this man named William Hamilton, who did write a book, and it was really the first book on technical analysis. So the revolutionary concept was that prices reflect the sum total of knowledge about the market. Smart money and dumb money, slow money and fast money, everything is in prices. And if you only follow prices, you can tell which way the market is going. You don't have to read balance sheets. And out of it grew this whole classical technical analysis: trend lines, heads and shoulders, double tops, double bottoms, rectangles, etc., etc., etc. To me, it's absolutely, totally, and completely dated. Dated because when you look at a chart and you start doing things like, is this reverse head and shoulders? Oh, is this a trend line? Or no, this is a trend line. Oh, is this a trend line? Or is this it's so subjective. And I have this terrible problem: my fingers shake when I trade. And when I'm bullish, they shake up when I try to draw a trend line. And when I'm bearish, they shake down. So to me, this classical charting is so wildly subjective. It's dangerous. The market doesn't know diagonals. If you put on a trend line like that, and now you change the format of this chart, the trend lines will have to change. There are only 2 things I really trust and use in classical chart. You can use all the time. I think horizontal lines matter. Horizontal support and resistance matter. They matter because people remember where prices bottomed out before. And when prices come back to that level, they're prone to buy. Same thing with the tops. Another thing I believe in a lot are false breakouts. So horizontal lines and breakout.
The message is simple. A named pattern isn't a reliable pattern. As Elder shows, classical charting relies more on guesswork than precision. Quick tip: forget the name. Ask yourself, what does this move say about buyers and sellers? If it's not clear, it's not useful. Now that we've seen the roots of technical analysis and its limits, let's look at what happens when traders try to apply it in real time. This next clip from Tom Hougaard shows how a strategy that works on paper can fall apart when real money is involved.
So it's not such a long stretch for us when we get engaged with technical analysis that we begin to connect one high with a secondary high and a third high, and we extrapolate a line out in the future, and we call that a trend line. And when a trend line has been broken, we get a signal. And it's a thing of beauty because, hey, it looks so easy when we are sitting doing our research. But the deception of charts, what we call apophenia, is playing a trick with us, meaning that we will gladly omit this trend line break. Yet when we are trading it in real time, all of a sudden we are seeing this trend line break. And so we are surprised when this happens, because during our research, it looked like this. There was a trend line break and the market stormed higher and we were on board, and now I'm trading it and it's not storming higher. In fact, it's trading lower and lower. In this case, you actually do get saved by the bell. But many a good strategies has been created on paper that are completely impossible to implement in real time.
The key point: most strategies don't fail because they're wrong. They fail because traders expect the market to follow the script of a backtest. It doesn't. Here's a tip: if your setup only works when you're calm and reviewing charts, it won't survive real trades. It needs to hold under pressure. Now, let's go deeper into one of the most famous books in technical analysis, and why it may be misleading traders more than helping. This next clip from Tom Hougaard is a sharp critique of the so-called Bible of charting, and a reminder that most chart teachers have never traded a day in their life.
See this book here? It's called the Bible of Technical Analysis. Not the King James Bible for Christians, but the Bible for Technical Analysis. It's written by Edwards and McGee. Were Edwards and McGee traders? Ladies and gentlemen, were Edwards and McGee traders? No, they were not traders. They were journalists. More than 1 million copies of this book has been sold. Normal leads to broke. And the brokers, they're well-meaning. They want you to do well. Why does a broker want you to do well? Well, hell, the better you do, the more you're going to trade. The more you're going to trade, the more commission you're going to place. It's logic. Of course the brokers want you to do well, CMC included. I'm not knocking CMC, but CMC are not traders. IG is not traders. City Index are not trading. Gain Capital are not traders. They're not the ones where you should be getting your guidance from. Sure, by all means, learn about technical analysis, but technical analysis has never made anyone anything. You're not going to get rich from trading by learning technical analysis. In short, your problem is not that you don't know enough about technical analysis. Will you trust me on this? That you don't need any more technical analysis. You need a serious review of how you think when you're trading. So let's try with that. My argument is that if 80-90% of people are losing when they're trading CFDs, this is not a broker problem. This is a human problem. And particularly, I think I mentioned it before, I believe that those 80-90% are perfectly rational people. Intelligent, good-looking, smiling, good mums, good dads, good students, good everything. They're just rubbish traders because they haven't learned to think properly. They haven't learned to deal with fear.
The takeaway: most traders don't fail from lack of knowledge. They fail by trusting the wrong people and ignoring their own behavior under pressure. Something to remember: if your strategy comes from someone who's never traded, throw it out. Real traders teach from real experience. Up next, David Paul shares 2 entry setups he's used for years, proven by time, testing, and execution.
If I was going to pick one methodology, I would look at a gentleman by the name of H.M. Gartley. He wrote a book in 1930 called Profits in the Stock Market. It's an absolute gem. In the book, on page 222, there's a pattern. And the pattern is called a Gartley 222. And it's very, very similar to Richard Wyckoff's upthrust. And they produced this work. There was no internet in those days. People didn't know each other. So they produced the work independently. So a Gartley 222 is a thrust up the page and then a 3-wave pullback. It's got some geometrical characteristics. And I think that anybody listening can find details of it on the internet. There's quite a bit of it out there. But that's my favorite entry tool. So a bullish Gartley is a thrust and a 3-wave back. And there's geometry. It normally stops at 61% or 78% of the upthrust. And a bearish Gartley is down and then 3 legs up. So you're selling at a really, really good level. And those are my two best entries. Now, the bullish Gartley and the Wyckoff Spring are pretty much the same thing, okay, except that Wyckoff didn't look at a great deal of Fibonacci analysis. And similarly, the bearish Gartley and the Wyckoff upthrust are pretty much the same thing. Okay, the gist is the same. So those are my two favorite entries, and I say it with my trading partner, we say it all the time. Why don't we just sit and wait for Gartleys to pitch up? There are some other patterns as well. These are Fibonacci-based patterns. There is a pattern called a 3 drives pattern. And I traded it the other day on a daily chart of the dollar against the Canadian dollar. And this is a pattern which is counter-trend, where the market was falling, there was bullish divergence, and the market, in fact, drives down 3 times to a low with a great deal of Fibonacci levels there. And I managed to buy the Canadian dollar right at the cusp of the turn. And that fellow that said that technical analysis doesn't work, I would like to show him the chart, okay? It's I don't look competitive, I know, at 61, but it's a great thrill to be able to take those guys on in the city and beat them.
The takeaway: solid entries aren't guesses. They're structured, repeatable, and clear. That's what gives you a real edge. This is where the edge begins. Don't collect patterns. Pick 1 or 2 and master them. But entries are just the start. The real challenge comes after you're in the trade, when emotions take over. In this next clip, Tom Hougaard explains why most traders don't fail from bad analysis, but from bad thinking in the moment.
Successful trading is not about charts, it's not about fundamental analysis. It is how you think when you are in a position, be it a winning position or a losing position. And as I often say, when people are in a winning position, they have a tendency to get afraid that their position is going to turn against them. And when they are in a losing position, they have a tendency to hope that the market is going to turn around and take them out whole. But the reality is that when I'm in a winning position, I think positively about it and I add to my winning positions, i.e. I compound to make the position even bigger. But when I'm losing, I step back and say I'm just wrong. And I think the vast majority of losing traders does exactly the opposite of how I do it.
What separates winners from losers isn't strategy, it's discipline. Most traders panic in profits and pray in losses. That's what kills performance. Most traders miss this. In profit, plan your exit. In loss, cut it clean. Your edge begins when you flip those instincts. But what if those instincts aren't really yours? What if your brain is wired to react the wrong way? In this next clip, David Paul breaks down how fear hijacks your mind and why staying present is the only way to stay in control.
We've got 2 brains. I'm sure you've all heard of the reptile brain and the front lobe brain. Well, I want you to think now, folks, that you're a summer's afternoon and the barbecue's going and kids are having fun playing football, right? And you're standing there. A ball comes out of nowhere. Football comes out of nowhere. What do? Duck. Yeah? Without thinking about it. A similar situation, but standing there Sunday afternoon and somebody throws a ball at you very slowly. What do? You catch it. Okay. So if somebody chucks a ball at you really fast, believe it or not, and according to this professor of psychology at UCT, there's a part of your brain that actually reacts, and it reacts up to half a second faster than your normal brain, this reptile brain, and its job is to keep you out of trouble. And frequently that happens in our trading as well, where have you ever done something dumb that you've sworn you'll never do again? Okay. And that's because that reptile brain is in fact trying to keep you away from danger. Not a lion about to hit you, but in fact emotional danger. And another example is that you're driving along a road and a dog comes out. Do you swerve? Yeah, you probably do. And you've said to yourself 1,000 times that I'll never swerve again. I'm going to drive straight. But in the moment, that reptile brain. So there's a part of you, if you're not present, folks, there's a part of you that's designed by the Almighty, or whoever you believe in, to keep you safe and well, away from physical danger, away from emotional danger. And if you're not present, you'll find that you keep doing really, really, really dumb things. So when you're sitting in your trading desk, it's really, really important that you're totally and utterly there. Not thinking about the past, not thinking about the future, totally in that moment.
The message is simple. If you're not fully present, you're not trading. Your instincts are. And those instincts can destroy your best setups. Simple, but powerful. Treat presence like a skill. Take 1 minute before each session to breathe and reset. Focus is your first line of defense. Now, to wrap things up, we go back to Tom Hougaard with a sharp look at how he prepares mentally each day. No charts, just mindset, review, and the hard truth. Technical analysis alone won't get you there.
I'm going to show you a picture now, and I'm just going to let that sit. And I want you to imagine you're there. Imagine that's you. Can you feel that in your stomach? I don't know how you feel about it. But looking at those pictures is part of my preparation. And if I have the choice between looking at charts, preparing, doing my ratios, all these things, or I just have time for mental analysis wins 100 out of 100. And then the next step in my preparation, and this is preparation I do in the morning, and if I have been allowed to show you, you will see that I have a PowerPoint presentation with approximately 1,300 slides. All of those slides show my past trades with handwritten notes that I've then scanned. So I will select 20, 30 of those slides. It's a rather large pile I can choose from. So I'll just take 20 or 30 of these in the morning as I mentally prepare. What you're seeing here are my profits and losses during the day. So there's some minus 25,000 pounds, minus 10,000 pounds, plus 57,000 pounds, plus 20,000 pounds, plus 20,000 pounds. So there's some whopping profits in there, some whopping losses. But more interestingly is this one here, for example, I was plus 20,000 pounds, but I only made 8,000 pounds out of it. Am I sour that I only got 8,000 pounds out of the position? No, because that's part and parcel of the game. I need to remind my mind in the morning ahead of trading game starting that it is perfectly okay to see a big profit turn into a small profit, because how else are you going to get an even bigger profit? And you might think, I'm never going to trade 200 pounds a point or 300 pounds a point. I did this when I was trading 5 pounds a point. And if I hadn't done it trading 5 pounds a point, I would have never gotten to 6 pounds a point. And 7 pounds a point. And so forth. It's not the size, the number of digits that you are trading. It's about trading the right way. And ladies and gentlemen, do you now understand why this has got nothing to do with technical analysis? While technical analysis is an inferior way of getting money out of the market. And mind is be-all, end-all. It is paramount to think the right way, because otherwise you're going to be emotionally robbed of your greatest opportunity.
The message here is simple. Charts don't make money. Your mindset does. Hougaard isn't preparing with predictions or indicators. He's training his mind to handle pressure, loss, and uncertainty. This matters more than you think. Before every session, take 5 minutes to review your own trades. What worked? What didn't? That small habit can change everything. Now let's bring it all together. You've just heard from some of the most experienced traders out there. people who've seen behind the curtain of technical analysis and know what really matters in the market. Here's what they all agree on. First, never trust a pattern just because it has a name. If you cannot explain what buyers and sellers are doing behind the move, the pattern means nothing. Second, strategies that only work in theory will fail in live markets. You must test under pressure, not only through backtesting. Third, don't learn from people who never trade. If your mentor has no real experience in the market, look elsewhere. Fourth, focus on mastering high-quality setups. You do not need more patterns. You need stronger execution. Fifth, reverse your natural instincts. Add to winning trades, cut losing trades quickly. Most traders do the exact opposite. Sixth, stay mentally focused while trading. You cannot manage risk correctly if you are emotional, distracted, or impulsive. And finally, seventh, train your mindset every single day. Your edge is not only in the chart, it is in the way you think before the trade even begins. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.